So, the tariff won on Monday. By Friday, America had lost more than the win was worth, not by a small amount, not in a way that requires careful interpretation or selective reading of ambiguous data, by a specific, documented, publicly available margin that every currency desk, every bond trader, and every portfolio manager in the world calculated before the market closed on Friday afternoon, and that the administration has not addressed, has not contextualized, and has not produced a number to contradict. Here is what happened in 5 days. On Monday morning, the administration announced what it characterized as a significant victory in the Canada trade dispute. Canada had agreed, as part of the ongoing bilateral reassessment, to pause the next phase of its $200 billion government procurement redirection, a pause worth approximately $31 billion in delayed Canadian government contracts that would not, under the pause, be formally redirected away from American suppliers for 90 days. The administration declared this a win. The tariffs were working. Canada had blinked. The pressure strategy was producing results. The dollar dropped. Not immediately, not in the first hour, while the announcement was still being absorbed. By Tuesday afternoon, the dollar index, the DXY, which measures the dollar's value against a basket of the world's major currencies, had fallen 1.2% from its Monday open. That is a large, single-week currency move for the world's reserve currency. 1.2% of the dollar's value, applied against a $26 trillion American economy, represents a reduction in dollar-denominated wealth that is several orders of magnitude larger than $31 billion. Markets were not celebrating the win. They were pricing the win as evidence that a comprehensive resolution of the $760 billion trade relationship was not coming. By Friday close, the net arithmetic of the week, the $31 billion procurement pause, 1, minus the dollar depreciation cost, minus the lost Canadian energy normalization discussions that the proclamation of victory had effectively ended, minus the supply chain redirection that continued accumulating while the political apparatus managed the optics of the announcement, was not a positive number. Warren Buffett, who has spent 63 years distinguishing between winning a negotiating point and winning a negotiation, said, "A victory that costs more than it captures is not a victory. It is an expensive way to lose." When you understand what the market was actually pricing when it dropped the dollar on a week the administration declared a win, and when you understand the specific arithmetic of what America held on Friday that it had not held on Monday, you'll understand why senior economists are using a word tonight that governments hate to hear applied to their trade strategies. Hit subscribe, because the dollar is still moving, and what it is pricing is not what the official statements are describing. Let me walk you through how we got here, because a currency market that drops the dollar 1.2% in a week when a government declares a trade victory is not making an error. It is telling you something specific, and you need to understand what the market knows to understand what it said. For 161 days, the administration had been telling a story about the Canada trade dispute that had a specific structure. The structure was, we applied pressure, the pressure is building, the pressure will eventually produce concessions, and the concessions will justify the strategy. The narrative was internally coherent, as long as the question of what constitutes a sufficient concession remained undefined. Undefined thresholds of success are easier to claim as you approach them. The administration had been approaching the threshold for 161 days, describing each week's status as progress, without specifying what the destination looked like in numerical terms. Then Canada offered the procurement pause. And the administration, under political pressure from 8 Republican senators, from 3 governors who had conducted back-channel outreach, from Buffett's 4-sentence statement that the IMF had subsequently validated with 40 pages of documented economic methodology, from a doubleted clock that was running in Geneva, regardless of anything happening bilaterally. The administration needed to show something that could be called a win. The $31 billion procurement pause was the something. Most people don't understand why the dollar dropped when victory was announced. Because the conventional understanding of a trade war victory is that winning is good for the currency. Winning demonstrates national economic strength. Winning validates the strategy. Winning should produce confidence. The conventional understanding is right in the long run. What it misses is what specific kind of win the market was pricing, and what the market concluded this win was evidence of. The market was not evaluating whether Canada had made a concession. Canada had. The market was evaluating what kind of concession it was, and more specifically, what kind of resolution it signaled was coming. And the $31 billion procurement pause told the market something very specific. The administration was willing to declare victory on an outcome that preserved the form of the tariff pressure while producing almost none of the structural resolution that the $760 billion trading relationship required. The $31 billion procurement pause was not a resolution of the tariff dispute. The 25% tariff on $760 billion in annual trade remained fully in place. The $14.2 billion daily flow was still moving through the same friction layer. The W to filing Canada had made at 2 a.m. was still proceeding through its own timeline in Geneva. The $89 billion in permanently redirected supply chains was still permanent. Canada had paused one element of one counter strategy for 90 days. Everything else was unchanged. What the market had been pricing. In the currency appreciation that had accompanied the 60-day structured reassessment window, and in the modest positive equity movements that had followed Buffett's midnight call, was a comprehensive bilateral framework. The kind of resolution that would restore the full $14.2 billion daily relationship to something approaching its pre-dispute architecture. The kind of win that would address the $89 billion in permanent supply chain redirection by creating the economic conditions under which redirection was worth reversing. The kind of outcome that would allow the W to clock in Geneva to be paused by a bilateral agreement of sufficient depth to justify the pause. Before that adjustment happened, it is worth being precise about what the market had actually been pricing in the weeks before Monday. The 60-day structured reassessment period, initiated after Buffett's midnight call to Carney, had produced a specific kind of market optimism. Not the optimism of a problem solved, but the optimism of a problem being addressed by people who understood its dimensions. The currency market had repriced the dollar modestly upward during the first weeks of the reassessment window. Bond markets had moved in directions consistent with reduced trade risk. Equity markets, in the most exposed sectors, had recovered a meaningful portion of what the original tariff announcement had cost them. All of that was the market pricing a probability distribution that included, as a significant scenario, a comprehensive bilateral framework emerging from the 60 days. The $31 billion procurement pause told the market precisely how likely that comprehensive framework was. The Monday morning announcement told the market that was not what was coming. What was coming was a $31 billion procurement pause, declared as a victory, with the underlying tariff structure entirely unchanged. The market adjusted its probability distribution accordingly, and the mechanism through which it expressed that adjustment was the currency. The dollar dropped 1.2% in 4 trading days. That is what the market said the win was worth. The press conference was scheduled for 10:15 on Monday morning in the James S. Grady press briefing room of the White House, the room with the blue backdrop and the podium that has been the visual anchor of American executive branch communications for decades. The room was full. The Canada trade dispute had been the most consistently covered economic story of the administration's term, and a Monday morning announcement flagged in the Sunday evening communications traffic as significant had produced a full press corps turnout before 10. The trade representative arrived at 10:19, 4 minutes behind schedule. He carried a single page of notes, a deliberate visual signal, the kind of controlled informality that White House communications teams use to suggest that the announcement is so clear and so strong that extensive documentation is unnecessary. He smiled before he spoke. That detail is in the pool report. He smiled, and then he said, Canada has agreed. The specific language of the announcement took approximately 4 minutes to deliver. Canada had agreed, in the context of the ongoing bilateral reassessment process, to pause the implementation of the next phase of its Strategic Economic Sovereignty Framework's procurement redirection component. The pause would last 90 days. During the pause, the approximately $31 billion in Canadian government contracts scheduled for redirection away from American suppliers would remain open to American companies. The administration characterized this as evidence that the tariff strategy was producing the intended leverage effects, and that the Canadian government had concluded that the cost of continued escalation exceeded the benefit of continued resistance. The trade representative took questions for 11 minutes. The questions were the questions you would expect. What about the underlying tariff? What about the W filing? What about the $89 billion in already redirected supply chains? What about the energy cooperation agreements Canada had declined to renew? The answers were the answers that the White House communications team had prepared. The process was proceeding. The strategy was working. The $31 billion pause was evidence of progress, and further details would emerge through the ongoing bilateral working group process. At 10:34, the press conference ended. At 10:37, the first major currency desk in London, which had been watching the feed from the early morning European session, updated its dollar model. The update was 3 words in the trading note that circulated to the desk's clients: insufficient for resolution. By 11:20, 6 additional currency desks had circulated similar assessments. The DXY, which had been trading at its Monday open level of 97.4, began to move. Not dramatically, not in the sudden lurching way of a crisis, but with the steady, directional, conviction-backed movement that currency professionals distinguish from noise. This was not a market overreacting to a surprise. This was a market updating its model after receiving information that was less than what the model had been pricing. By 3 p.m. on Monday, the DXY was at 96.9, 0.5% down in a single session, on a week where the administration had declared a trade victory. By Tuesday close, it was 96.2. By Wednesday, after the Canadian government released a statement confirming the pause, in language so carefully hedged that trade lawyers spent hours parsing whether it was a confirmation of the terms the administration had described or a more limited acknowledgement. The dollar stabilized briefly before resuming its downward movement Thursday morning. Friday close, 95.9, 1.2% below Monday's open. In a week of declared victory, in the retirement accounts of the 45 to 75 demographic that this channel serves, the Americans who hold dollar-denominated savings, dollar-denominated pensions, dollar-denominated fixed-income assets, a 1.2% dollar depreciation in a single week is not an abstraction. It is a reduction in the purchasing power of every dollar they hold. It is the international price of the week's events denominated in the most honest currency there is, not political narrative, not press briefing language, not rally speech arithmetic. The currency market. By Friday, the $31 billion win had been weighed by the most sophisticated economic assessment mechanism in the world. The mechanism had delivered its verdict before the closing bell. The immediate reaction inside the administration was not to the currency movement. It was to the gap between the announcement's political reception and its market reception, a gap that produced, by Tuesday afternoon, the specific kind of internal pressure that political operations experience when the story they are telling and the story the market is telling are diverging in real time. The communications team had prepared for a positive news cycle. The Sunday evening traffic flagging the announcement had produced the expected pickup in favorable coverage. The cable news segments about Canada blinking, the political commentary about leverage working, the social media ecosystem that processes trade war developments through the lens of political team affiliation. On that axis, the announcement had worked. The political story was a win. The currency markets do not watch cable news. They read the announcement, calculated what it meant for the probability of comprehensive resolution, and sold dollars accordingly. By Tuesday, economic reporters who cover markets rather than politics were writing the second story. The dollar story. The gap story. The story that was asking whether a $31 billion procurement pause was sufficient to justify declaring victory on a dispute affecting $760 billion in annual trade. By Wednesday, both stories were running simultaneously, producing the specific cognitive dissonance that administrations find most difficult to manage. The political story and the economic story were not just different in emphasis or framing, they were arithmetically incompatible. The political story said the tariffs had won something. The economic story said the winning of that something had cost more than the something was worth. According to sources familiar with the administration's internal response, the currency movement produced a specific disagreement between the political communications team and the economic advisory team about how to characterize what was happening. The political communications team wanted a statement saying the dollar's movement was unrelated to the trade announcement and reflected other global factors. The economic advisory team could not produce supporting analysis for that characterization. The statement that eventually emerged on Wednesday cited global currency dynamics and expressed the administration's confidence in the fundamental strength of the American economy. It did not mention the DXY. It did not mention the $31 billion procurement pause. It did not contain a number. Canada, for its part, said nothing about the currency market's response to a pause it had agreed to. The pause was real. The 90 days were real. The $31 billion in delayed contract redirections were real. None of that changed because the currency market had concluded the pause was insufficient. Canada had given what it had given and was now watching, with characteristic patience, what the American government did with it. There is a specific detail about the Canadian government's reaction to the dollar's movement that has not appeared in official coverage, and that one source familiar with Canadian government discussions described in terms that carry their own weight. When the DXY fell through 96 on Tuesday afternoon, a senior Canadian official, watching the currency move from an office in Ottawa that has been monitoring American market reactions to every development in this dispute for 161 days, said according to that source, something that is best understood not as celebration and not as analysis, but as confirmation. He said the market agrees with our assessment of the announcement. 4 words. The market agrees. Delivered, according to the source with no particular emotion, the way that people who have been correct for a long time deliver confirmation that they were right. Warren Buffett's response, released Thursday morning as a brief statement to financial press, explained the market with the precision that comes from 63 years of having always been more interested in what markets say than in what governments say about what markets should say. Warren Buffett released his statement at 7:51 on Thursday morning before the market opened, which is where he places statements when he wants the market to process them before trading begins, rather than in the noise of an active session. 4 paragraphs. The first addressed what the market was saying and why it was correct to say it. The second addressed the specific arithmetic of the week. The third addressed the historical dimension. The fourth was his verdict. A currency market that drops 1.2% in a week when a government declares a trade victory is not making an error, Buffett wrote. It is correcting one. The market was pricing a comprehensive bilateral resolution of the Canada trade relationship, the kind of structural outcome that would allow the $14.2 billion daily flow to resume at something approaching its pre-dispute architecture. The announcement on Monday told the market that what is coming is a 90-day procurement pause on $31 billion in Canadian government contracts, with the 25% tariff, the W-2 filing, the $89 billion in permanently redirected supply chains, and the Energy Cooperation Agreement non-renewals all unchanged. The market priced the distance between what it was expecting and what it received. 1.2% of the dollar's value is what that distance cost. He turned to the arithmetic. In 63 years of investing, I have developed a specific allergy to the formulation that a strategy is winning when the evidence of winning costs more than the win captures. The $31 billion procurement pause is a real outcome. Canada agreed to it. The 90 days are real. But 1.2% of the dollar's value against the $26 trillion American economy is approximately $312 billion of currency-denominated wealth reduction in a single week. $312 billion against $31 billion. The arithmetic of that ratio is not the arithmetic of a winning strategy. It is the arithmetic of a strategy that has confused the appearance of progress with progress itself. He continued into the historical dimension that gives his assessments their specific gravity. I have watched, in 63 years, a specific pattern in negotiations that produce declared victories before achieving actual resolution. The pattern is this: the declaration of victory changes the incentive structure of the negotiation. The party that declared victory now has a political interest in characterizing the remaining distance to resolution as smaller than it is, because acknowledging the remaining distance would diminish the declared victory. The party that made the concession now has a strategic interest in making the remaining distance appear larger than it is, because a larger remaining distance increases the value of further concessions. The negotiation continues, but the information environment in which it continues has been distorted by the declaration. And distorted information environments produce distorted outcomes. The currency market is not distorted. It priced the remaining distance between Monday's announcement and comprehensive resolution at 1.2% of the dollar. That is the market's assessment of how much further there is to go. Buffett's verdict: the tariff did not win on Monday. On Monday, an administration that needed a win accepted a concession worth $31 billion and declared it a victory over a $760 billion trade relationship. By Friday, the currency market had calculated what that declaration cost. The score at Friday close was not what the Monday morning press conference described. Trades that cost more than they capture are not wins. They are expensive lessons in the difference between a narrative and a result. What a 1.2% dollar depreciation in a week of declared trade victory produces. In the economic terms that matter to the 45 to 75 audience, whose retirement accounts, fixed income portfolios, and purchasing power are denominated in dollars, cascades through every layer of the financial system that those accounts depend on. Begin with the most direct layer: purchasing power. A 1.2% drop in the dollar's value in a single week means that every dollar held in savings, in pension accounts, in Social Security trust funds, in the fixed income allocations of retirement portfolios, bought 1.2% less of the international goods and services that dollar-denominated savings are used to purchase. Prescription medications whose active ingredients are manufactured internationally. Electronics, consumer goods whose components cross borders, including specifically the Canadian border, multiple times before reaching American retail shelves. A 1.2% depreciation in a week is not catastrophic in isolation. It is significant as a weekly rate because it is not sustainable. A dollar that drops 1.2% in a week of declared trade victory is a dollar that markets believe is in an environment where victories cost more than they produce. And that belief, if it persists, compounds. The fixed income dimension is the one most directly relevant to the demographic this channel serves. Americans between 45 and 75 hold the largest concentrations of U.S. Treasury bonds, corporate bonds, and fixed-rate pension commitments of any demographic cohort. All of those instruments are denominated in dollars. When the dollar drops, the real value of those instruments their purchasing power against the basket of goods and services that retirement actually costs declines. 1.2% in a week is not retirement destroying, but it is a week's worth of evidence about the direction in which the political management of the $760 billion relationship is pointing the currency. And retirement planning cannot ignore directional evidence. The energy dimension is the most immediately practical. The Canadian government's decision not to renew the 3 bilateral energy cooperation agreements, the pipeline access arrangements, the electricity transmission agreements, the joint grid management protocols, had been proceeding quietly through its wind-down process since Canada announced the non-renewals weeks earlier. The procurement pause Canada agreed to on Monday had not addressed those agreements. But the Monday announcement had created a political dynamic in which raising the energy agreements would have appeared to diminish the win. According to sources familiar with bilateral discussions, the energy cooperation agreements were specifically not raised in the conversations that produced the $31 billion procurement pause, because raising them would have complicated the announcement. The American utilities whose planning depends on those agreements are now operating with 90 days of procurement pause and continued wind down of the energy framework. That is not the same thing as resolution. It is closer to the opposite. The adversarial dimension, the one that receives the least official discussion and carries the longest strategic consequence, is what the Friday close of the DEXI communicated to every government that has been watching American trade strategy for 161 days. China watches the dollar the way a geopolitical competitor watches a rival's balance sheet. A reserve currency that drops 1.2% in a week of declared victory is a reserve currency whose managers have made a specific calculation that markets disagree with. That disagreement is visible. It is denominated. It is in every database that tracks currency performance, and it is available to every capital that uses dollar strength as a proxy for American economic management quality. $312 billion against $31 billion in 5 trading days. The lesson is not subtle. The market stated it with the bluntness that markets deploy when they have calculated the arithmetic and the arithmetic does not close. What happened between Monday's press conference and Friday's close is not complicated. It is arithmetic. The kind of arithmetic that a currency market performs faster and more honestly than any communications team. Because currency markets do not have political relationships to protect, do not have strategic narratives to maintain, and do not have press briefings to manage. The trade dispute had produced, in 161 days, a specific set of measurable outcomes. $760 billion in annual trade disrupted, $14.2 billion in daily commerce, still moving through a 25% tariff layer, $89 billion in permanently redirected supply chains, a W to clock running in Geneva, 8 Republican senators who had broken publicly with their president, 3 governors who had conducted back-channel diplomacy without authorization, 2 Buffett statements, 1 midnight phone call, 1 IMF correction of $353 billion in claimed tariff revenue, and 1 41-page W to filing made at 2 a.m. without a courtesy notification. And on Monday, as the product of all of that, $31 billion in Canadian government contracts paused for 90 days, with everything else unchanged. Warren Buffett wrote that trades that cost more than they capture are not wins. He wrote it Thursday morning before the market opened. By Friday close, the market had confirmed the calculation for the 4th consecutive session. The currency is not wrong. Currency markets are not sentimental, are not partisan, are not susceptible to the specific kind of wishful arithmetic that a press conference at 10:15 on a Monday morning can produce and sustain for a news cycle. They are the distilled judgment of every institutional actor in the global financial system about the real value of real policy decisions expressed in the most honest unit of measurement available, the purchasing power of the currency whose whose managers made the decision. The purchasing power of the dollar fell 1.2% in the week the tariff won. That is not a paradox. It is the answer to the question the title of this story asks. Trump's tariff won on Monday. The dollar dropped. And by Friday, the cost of the win had exceeded its value by the most reliable measurement the world possesses. What comes next, whether the $31 billion pause produces a comprehensive resolution in 90 days, or whether it produces 90 more days of managed stalemate and continued supply chain redirection, is the question the dollar will answer before any press conference does. The currency is already pricing it. And the $760 billion relationship is watching which direction it goes.